Hi everybody, welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi Debbie.
Hey, hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rates. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. This week's Stock Analysis Video Podcast, we're going over the online retail companies, and the two we think most about are Amazon and Alibaba. Now, we know that Amazon is one of the largest online retailers, and the company opened its virtual doors in 1995, and I was the happiest camper in the world when I knew that I could order Christmas gifts for my three sisters without going to the mall, and I got them all cookbooks. Yeah, that's still a sore spot in the family. Anyway, the sales breakdown: North America 60% of sales, international 31% of total. Amazon Web Services is 9%, and third-party sellers in their marketplace account for about 20% of sales. And they acquired CD Now in 2002, Audible.com 2008, Zappos 2009, Whole Foods Market in 2017, has about 250,000 employees, well, 230,800, close enough. And when we look at this clean surplus ROE, which is the first number we want to look at, and we can see that ROE is extremely, extremely high. And folks, it is just out of sight. When we see a company about 20%, we get all excited. But here, this company is just totally out of sight, making all kinds of money. And when we look at the net income growth, we see that it is very, very high at almost 25% projected for 2020, and revenue growth 14.4%, which is way above average. And we'll see the averages right toward the end. And when we look at the one-year return, we can see that this stock is up about 14%, while the market is up about 8%. So it's almost doubling the S&P at this point in time. But we would think that a stock like this would be doing much better than the averages because of that high ROE. And when we look at the 5 years, there it is. It's up almost 500%, while the market is up about 50%, so 10 times more than the market. But you can see that in the past 12 months or so, the stock has really gone no place except down in the fourth quarter of 2018, with the entire market down about 20%. So this stock dropped, and it now is clawing its way back and trying to reach previous highs. Now, getting on to Alibaba Group, it operates as an online and mobile commerce company in China and internationally, and it is the largest such company in the world in terms of gross merchandise volume. But folks, don't let that fool you, because we will see in a little bit that Amazon is making a much greater profit. And again, Alibaba is the largest company in terms of gross merchandise volume. Its major businesses include the Taobao Marketplace, which is China's online shopping destination, the Tmall.com, Chihua Swan, I have no clue if I'm pronouncing that anywhere near how it's supposed to be pronounced, but it's their online buying marketplace, Alitrip, which is their online travel, and has 66,000 employees. So folks, it is much smaller in employees than Amazon, but it's not making as much money. And when we look at the clean surplus return on equity, we see that one thing that is noticed right away is that it's a nice high ROE, but that ROE has been dropping. Now, don't forget, Alibaba has a currency problem because when we look at the price of Alibaba, we look at it in dollar terms. And so when the Chinese currency, which has been devalued as of late because of the trade war going on, that shows up in the price in US dollars. Now, the net income growth for 2020 is 8%. So that has dropped, and that's a key concern of the markets, and we'll see that in the price in a second. And revenue growth for 2020, 6.1%. Now, the revenue growth over 5 years and the net income growth over 5 years is nice, very nice numbers, but we can see a real slowdown in 2020, and that's why the stock has not done well. And looking at past 1 year, we can see it is down about 6% with the market up about 7 or 8%, so it's been lagging the U.S. market. Now we are comparing Alibaba with the U.S. market, and Alibaba is in dollar denomination when we look at the price of the stock. Now, over 5 years, it's outperformed the S&P 500, with the S&P up about 50%. This stock is up about 90%, so almost doubled the S&P over the past 5 years, and most of that has come 2017. So 2017, 2018 were pretty good years for this stock, but in the last part of 2018, along with the U.S. stock market, it declined rather drastically, but finishing the 5 years out almost twice as high as the S&P. Now, when we look at these stocks together, the average ROE for the average stock in the S&P 500 about 13.5%. Amazon has a 51% ROE for 2020. Alibaba, 20.8%, which is not shabby. Now, with net income growth, Amazon, 138%. That's the 5-year number. And Alibaba, 21%. Revenue growth, Alibaba at 34%, beating Amazon at 23%, and both of these are 5 and 6 times higher than the average stock, folks. So don't think that these stocks are not good when we look at these numbers. When you think about the market averages, these stocks are way above the market averages in every category. They don't pay dividends, which means they're both putting all the money they're making back into the companies in order to grow. And when we look at the notes on Alibaba, the thing that worries us is the decline in the ROE for Alibaba, while Amazon's ROE is going up. And then also for Alibaba, the currency exchange. So as the U.S. puts on more tariffs on China, China will try to devalue its currency so that Chinese goods sold in the United States look cheaper or are cheaper relative to the U.S. dollar. So as the U.S. puts on more tariffs on China or any other country, those countries will try to devalue their currencies, and the drop in the price of the goods relative to us, relative to the U.S., seems lower, but the tariffs are increasing. So one's trying to offset the other is where I'm going with that. So bottom line, looking at the past year, Amazon has outperformed the S&P 500. Alibaba has underperformed the S&P 500. Over 5 years, Amazon up almost 500%, with Baba up about 90%, and the S&P 500 up about 50%. So over 5 years, both stocks are outperforming, but Amazon over the past 3 and 4 and 5 years has just exploded and has just gained so much more than Alibaba has. So Amazon is in our growth portfolio. Alibaba is not at this time, especially with currency fluctuations and that declining ROE. So we'll sit on the side with Alibaba for now, and let's see what happens next year as the currency wars may be coming to an end once the tariffs get all straightened out. In other words, once we get a trade agreement with China and the rest of the world.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, We're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.